Hello and welcome. You're tuned in to KYC. I'm Harsh Saita. With me is Mahima Vachajani, and what we're going to do today is we're going to speak about V2 Retail. It's a value retailer and it's in focus because of the kind of stock price action that it's seen over the last year or so. The stock has more than doubled, 2.5 bagger over the last year. But look at the last 5 years. In fact, from June of 2020, and maybe that's a low base, the stock has been on an incredible run. It's up maybe nearly 40x, but to be absolutely precise, 34x since that point. So it's been a phenomenal story that's playing out in front of us, Mahima. And it's important to understand at this point because FY26 could well be that year where rural starts to participate. We've seen rural under a bit of pressure last couple of years. Can rural start to actually participate this year, given the way monsoon is playing out? But the kind of growth base that the company has built for itself over the last couple of years is extremely high. So my first question, therefore, is can growth sustain on this kind of base? Store levels need to go up for that. Same store sales growth needs to sustain with store levels going up. And you have average selling price, which also has crept up, and that also, can it sustain above that 300 mark, will be the question. Because for full year FY25, it's a shade below 300, but Q4 was above 300. So is that the new normal? Is that the new base? The second part of this is, can growth sustain without discounts? Now, discounts have come down marginally in FY25 on a very, very low base. So that's a positive, but can that sustain? Rural pickup in FY26, if that were to happen, states of UP, Bihar will well benefit from that tailwind, even a Jharkhand, even an Odisha, where V2 Retail has a significant geographic footprint, and that will obviously further aid the numbers for it. Factors to consider, especially when it comes to store shutdowns, and they do this, very minor tweaks in terms of store shutdowns, but that could well be one of the drags, and you'll want to understand whether that is consistent year after year. I would want to quiz them this year and then thereafter next year as well to try and understand whether those factors are changing with regard to store competition. Challenges, store shutdowns. Challenges with regard to competition and possibly leading to poor execution. That could well be a risk for this one because we've seen very sharp growth. They are very steady in their commentary, but any slip up with regard to execution could well hurt the stock price as well as the performance, because it's certainly not trading at cheap valuations on a trailing 12-month basis. The average selling price, the trajectory is what I would want to understand. Margin risks, both on gross as well as on the pricing front. What is the calibration that is possible? And that interplay along with competition. And last off, with regard to cash flow, can that cash flow really sustain? Because in FY25, we've seen two positive things happen. One is your inventory has come down, even though your inventory days have come down, even though your inventory in absolute terms has gone up. And second is your payables have really ballooned, and that has helped working capital days to come down. And that has aided the cash flow from operations. Can that change and reverse? Is there a risk of that? Is what I would want to understand. So all of that. But first off, about V2 Retail, let's take you through the journey. It's been a large turnaround of sorts, Mahima.
Absolutely. It was incorporated in 2001 and it got listed on the bourses in 2007. It was renamed as Vishal Retail in 2011 after selling the entire Vishal brand, which was loss-making, and that was one of the reasons as to why it was sold. And V2 Retail stands for value as well as variety. In terms of the company, it primarily operates in Tier 2 and Tier 3 cities. So what you were talking about, because the past few quarters have been good in terms of rural spending, because rural has gone up as compared to something like an urban. And that is something that has augured growth for the company in FY25 as well. It caters to the neo-middle class and middle class demographics. So that's their overall audience. Like Harsh mentioned, their average selling price is anywhere between that 300 to 350 odd mark. In terms of their focus area, lowest lowest price given at quality, and of course with wide assortments. In terms of the retail presence, they are present in around 189 stores in more than 150 odd cities and in 20 odd states, and retail area as of March ending stood around 20.27 lakh square feet. In terms of their product design, there is in-house product development with a team of 25 odd designers right now. In terms of how their business is divided, well, it's divided in menswear, which is roughly 40%, ladies wear is 27%, kids wear is 25%, and lifestyle is roughly 8% of the overall counter.
I'm just going to chip in here.
Yeah.
See, this mix, when I was looking at it over the last 4 to 5 years, hasn't changed significantly.
Correct.
So we've seen this mix remain as is. And therefore, that's just something I want to call out, that this might not change as well into the future, because if it's not changed over the last 4 years, when the company has undergone tremendous transformation, this may well be the mix that we can continue to expect as well into the future.
And I think that also means that the company is able to understand as to what the consumer preference is, and their mix is therefore not changing. In terms of geography as well, there are expanding into strong cluster, of course populous clusters like UP as well as Bihar. They're entering into new states like Punjab, Bengal as well as Maharashtra. In terms of their overall footprint, Bihar has around 38 odd stores, Uttar Pradesh 35 odd stores, Odisha 26, Jharkhand 16, and MP and Assam has roughly 13 odd stores.
I again want to chip in here for a bit. So this basically, Bihar contributes nearly 20% of the store count. So does Uttar Pradesh. So these two combined would be nearly 40% of the store count. Just for perspective, they have 190 stores. So it's very important to understand this. The other piece is Odisha also contributes roughly 15%. So if I look at the top 3 itself, that's above 60% in terms of store concentration. And then if I add this 16 here of Jharkhand, that takes it to nearly
70 to 75
70 odd percent, right? So that kind of really adds up when you're looking at just the top 4 states contributing to 70%.
Correct. And these are the most populous states, right?
Absolutely.
With high rural penetration as well. So I think that is something that is working out well for the company.
Yeah. And then they're saying that 60 to 70% of new stores are also in existing clusters. Correct. They will focus in on the existing clusters and they will not go into new geographies. And even if they do, they'll be very cautious about it. So that kind of strategy, they're just focusing on what is working.
Correct.
The question after a point will be, is growth capped beyond a point if it's in the same geography and if they don't find new geographies? But that's just maybe one of the risks. But anyway,
and that could probably keep their overall sales per square feet metric as well, because that is one of the key metrics to watch out for when we study a retailer.
So the other thing, sorry, while we're talking geography, that really stood out when I was reading up on the company was the fact that their rentals have actually come down in the last 2 years. From 56 rupees per square feet, it's come down to 52 rupees per square feet. That kind of again stood out for me, because what they're saying is we'll focus not on, even within the core geography, they will not focus on the most populous part of the geography. They will go slightly outside where rentals are slightly lower. And cater to the value market.
Correct.
That's the other thing that really stands out. Where have you seen rentals really come off?
Correct.
I mean, commercial, we've seen rentals go up, while they are seeing a very different trend, and that's kind of aiding their cost structure as well.
Absolutely.
But sorry, please go ahead.
And aiding their margins as well. I mean, we see that later as well. In terms of their store strategy, like he rightly mentioned, 60 to 70% of new stores are from existing cluster. Plus, I think one thing that's standing out again here is the kind of focus on their private labels. Not every company is able to scale that up. Even Trent has tried to focus on their private labels, and that's something that is working for Trent as a big retailer, whereas your Vedant Fashions, your ABFRL has not been able to do that. But V2 Retail has been able to do that and has been able to scale that as well. In terms of manufacturing, they own a state-of-art manufacturing facility in Noida as well as Bihar. In terms of warehousing also, they're set to add a new 20 crore facility in Kolkata, and they also have an existing Gurgaon hub, which will support their overall future growth. Plus, interesting one here is that they use their own fleet to carry their overall inventory, and it's done. It's like a weekly process that they do. So that is also interesting. I think using that this metric as well, they're trying to have their control over how the company is working out their costs around, and that's how I think they're able to give the kind of guidance that they're giving in terms of margin as well as growth.
Correct. Design, manufacturing, and retail. They do all three across the value chain, and that kind of aids the numbers. But let's quickly look at the metrics that we look for with regard to a V2 retail. We start off with the income statement. We look at the balance sheet, cash flow, shareholding, return ratios, street cred, street coverage, as well as valuations. We look at all of those, and we'll try and give you a view with regard to each of those parameters. You want to start off income statement, Mahima?
Right, so I'll start off with the income statement. Of course, thumbs up here most certainly, because revenue 3-year CAGR has been an impressive 44%. EBITDA 3-year CAGR has been 61%, and margins also have been on a very good increasing trend. I mean, FY24 they stood at around 12%, 12.2%, which they've scaled to around 13.4% in FY25. Net profit has also grown threefold as compared to where it stood in FY24, and company became profitable, I believe, in FY23. So they've been not just able to maintain the profitability, but also scale in terms of their overall profitability, and that's why overall thumbs up when it comes to income statement. Even in terms of their operational metrics, it's important to point that out here. Since Harsh was also mentioning whether they'll be sustainable or not is one question, but FY25 same-store sales growth at 43%. I mean, no other retailer has seen this kind of same-store sales growth. Volume growth as well at 43%. Full sales price improved to 89%. Old inventory also reduced from 18% to 5%. Store economics, they added around 74 stores this year, and they plan to add 100 stores every year as per their guidance as well. And the last thing that stood out really well for me was that all of their stores become profitable from the first year itself, and they've said that the break even is at 500 per square feet sale. So that is also a very important thing and very interesting thing that came out of while reading the investor presentation.
500 per square foot. They do 750 to 800 in year one itself.
Yeah.
Thereafter, they scale up to 1,000 to 1,100 in 2 to 3 years. This is just for viewer perspective so that you have the complete picture on how it goes about. The break even is, of course, 500 rupees per square foot per month. But let's look at the balance sheet now. In terms of equity, it's healthy in terms of the overall equity, the number on your screen. Look at also the borrowing number. Now, mind you, the borrowing number excludes lease liabilities. Lease liabilities typically should be excluded from a rental perspective for a model that V2 retail typically follows. Cash and bank balance around 9 to 10 odd crore. So a thumbs up with regard to where the balance sheet is concerned. You want to talk about cash flow, Mahima?
Right, so healthy set of cash flow numbers as well. Cash flow from operations has nearly grown threefold from 93 odd crores to 223 crores in FY25. Plus, the cash flow from operation to EBITDA ratio is also quite healthy at 89 odd %. Net cash flow has slightly decreased, but that is because of what you were mentioning earlier as well, because of trade payables going up. That could be one of the reasons as to why the net cash flow has been impacted. But overall, a good set of numbers here as well.
Yeah, and so the other piece with regard to cash flow is that two things have happened. One is your working capital days have come down, and that's largely because your payables have gone up. Want to understand how sustainable that number is? There are reasons why that has happened. Won't delve into that in too much detail, but that's something you want to watch out for because that will impact cash flows going forward. Second, 220 crore odd of capex that is in the pipeline every year, of which 110 crore will be to inventory and another 110 crore in fresh capex for new store expansion. Stores typically take 1 crore or so in terms of capex per store. So 100 stores will likely mean 100 crore. Just kind of putting it out there. I fully aware that there's a lot of data out there, but let's talk about return ratios very, very quickly. Return ratios on an improving trajectory. Can they sustain will be the question. That's the ROCE number, but look at the ROE. It's gone up to 23% this time around. Can that really sustain is the question. At least the number seems to suggest that it will sustain, but I'm giving this a cautious tone and therefore a neutral shareholding.
Right. So shareholding, interestingly here, this is one company where, at least that I have come across where promoters have increased their shareholding over a period of time, which was at 53.6% to now 54.24%. So that shows that promoters believe in the company and are ready to invest in the company. FI holding has, however, come down from 6 odd percent to 1.3 odd percent. DI holding has gone up in the counter from 0.4 to around 6.7 odd percent. And overall public shareholding has slightly come down from the 38.8% mark to 37.7% mark. So I think overall a thumbs up, well-held company.
Okay, street cred. Let's look at the last year or so. It's done 154% in terms of returns. So it's been a 2.5 bagger over the last year or so. Year to date up 10%, not a bad return either. And you're looking at 5-year returns of 34x. And therefore, we've given this a thumbs up, the street cred. Valuations, Mahima.
Right. So valuations, we've given a neutral rating here, and this is solely because, it's both ways. The company is slightly cheaper than its peers, but at the same time, at 26 times trailing 12 months, it's not cheap in terms of how valuations are seen. So that's the only reason why we've taken a neutral approach here in terms of how it trades and this is EV to EBITDA, because a lot of other companies like Vedant Fashion or Arvind Fashions are still in losses, and that's why we've taken EV to EBITDA as metrics. But yeah, as compared to something like a Bazaar Style or something like a Vedant Fashion or FRL, it turns out to be cheaper. And interestingly, the FY27 estimated valuations go to around 11.5 times, which is quite a significant and quite an attractive valuations for an investor to look at.
Okay, now let's look at how your street coverage stacks up. Now there's just 2 analysts covering this one. 55% upside. Just given the limited coverage, we've been cautious. We've given this a neutral. Also, you want to quickly look at what the guidance is, and we've spoken quite a bit about some of these. 100 stores in FY26 over the next 4 to 5 years. They're expected to increase store count by 600 to 700. They're looking at a revenue growth of 45 to 50%. Same store sales growth of around 10%, EBITDA margin of around 8 to 9%. In fact, 2 years from now, the pre-Ind AS EBITDA margin, which is currently at 8%, is expected to go up to 10%. They're expecting ROEs to sustain. They're exploring franchisee model as well, but not under current consideration, but they're exploring it. No plans to enter premium. So all of that, we've given that a neutral. Plenty happening on this front. You want to watch out for all of those factors. Quickly on to how we rate this company. Finally, let's pull out all of the ratings. Let's stack them up and let's see how it adds up. There you go. Those are the 4 parameters. Let's look at the other 4. Let's give it the final rating, which is 6 out of 8. Not bad at all. No thumbs down either. So all positive or neutral. So that's the other big positive. But let's go across. We have Akash Agarwal, whole-time director, V2 Retail, joining us. Akash, good having you here. I want to start off with understanding whether this kind of revenue growth clip of 45 to 50% is really sustainable. You're at 189 stores right now. You're on an aggressive expansion spree. 100 stores last year was expected. You did 75. This year also 100. How deep is the market, Akash?
Yeah, hi. Thanks for having me. So to answer your first question, the actual target initially for last year was around 50 new stores.
Okay.
But since we were getting such good response in all the new locations that we were expanding to, and the SSSGs were much better than what we had actually predicted or estimated. So that's why we increased the store opening guidance, and we opened 74 stores. And that is why, in fact, we have increased the guidance for the next few years also. And we are well on track to open 100 stores this year and for the next 3-4 years.
Right. Akash, hi. Mahima also joining in. Just want to get your sense on margins. You did almost 13% ending FY25. How sustainable is that range, and what will be the levers of growth from there on?
So we always try to talk about pre-Ind AS margin. So pre-Ind AS EBITDA was 8% for us last year. And the scope, the levers that we have to increase that and move towards 10% in the next 2 to 3 years. So one would be, leveraging additional stores by using the same head office cost and warehousing cost. So your costs per square feet come down. The second lever is selling more at full price, so having a positive impact on the gross margins. And the third lever is the way we move from 650 rupees to 1,000 rupees. So the next target is to move up to 1,200 rupees per square feet per month. So these three things, levers would actually help us move from a pre-Ind AS EBITDA of 8% to 10% in the next 2 to 3 years.
Akash, I want to understand how relevant is rural pickup in everything that you're doing? Because rural is expected to pick up in FY26. One, are you seeing signs of that? Are you expecting that to happen? And how relevant is rural and rural growth from everything that you're anticipating in terms of pickup on the per square foot sale that you're penciling in?
So yes, rural is a big market to the customers that we actually cater to. And the good thing is the last 2 years there has been a rural demand pressure, and we've been able to show the kind of growth that we've been showing more than 30% SSSG for 2 years running. So I think when the macroeconomic picture is better, when the rural demand comes back, then it should obviously positively impact us, and we are waiting for that to happen. But it's not an excuse. Even if that doesn't work, we're still working hard on all the strengths that we have shown in the last few years, and hopefully the momentum can continue.
Akash, just want to get your sense. Last when I was reading your con call, you did mention that the e-commerce execution was delayed because of some technical difficulties. But you are planning on getting into the e-commerce space via your own website. Just want to get an update there as to how the development has taken place, and where do you expect your overall online sales to go as a percentage of your total revenue, let's say 3 years down the line.
So we are making e-commerce just an additional channel for our existing customers. We do not want to burn money in acquiring new customers. So, and we do not want to do a centralized logistics system. So what we are planning is an omni-channel system where all the inventory at the stores can be leveraged and delivered to the customers in the same city. So hence it reduces a lot of costs, and we save on a lot of return costs also. But even at a mature stage, I would say it wouldn't be a very significant number. The e-commerce would constitute about 5 to 10% of the business after it matures. But like I mentioned earlier during the con call, that we don't want to start it with having doubts over the technology partner or the technology behind it. So we want it to be 100% robust and automated. And that is why the delays are happening, because we're still trying to figure out who will be the best technology partner to take us forward in our omni-channel hopes.
Akash, you're profitable, you're focused on profitability, you're focused on cash flow. Your cash flow has seen a bit of a turnaround in FY25. For viewer perspective, give us that perspective as to what has changed in FY25 versus earlier on the payables front especially, and can that sustain?
So there's a uptick in payables because earlier, so we have a subsidiary which has our manufacturing units. So about 20% of our sales used to be manufactured in-house, and the credit term for our subsidiary was 0 days. But that percentage has come down from 20% to less than 5% now. So that has positively impacted the working capital cycle, because the average credit that we get from vendors is 45 to 50 days. And that is why you're seeing a much better cash flow from the credit working capital cycle.
Sustain, Akash.
Yes, so we target an inventory days of about 90 to 100 days, and we've been able to actually reduce it by 10 days. And the plan in the next 18 to 24 months is to actually reduce it by a further 10 days. And if we are able to do that, and even if we maintain the average credit days that we are maintaining now, we would be able to reduce our working capital cycle by another 10 days.
So your cash flow to EBITDA, just trying to understand, would that be around the 80% number even then, or can you improve that further?
No, that should remain at around this number going forward.
Okay, understood. And what gives you the confidence, Akash, that the market is deep enough to do 600 to 700 stores over the next 5 years?
So there are retailers already with 1,000 stores. I think there are retailers with more than 1,600 stores of a particular brand. So that looking for new locations or new cities is not a problem yet. I think for that we need to reach the 2,000 or 3,000 store number. So till then, it's all about we have more options that we want to open. So I think India, with the growth trajectory that it's on, and with the booming, middle class, and more people crossing the per capita income threshold, where they have more disposable income. So I think it's all positive, and this number will keep on increasing.
Thank you so much, Akash, for coming in and speaking with us. Completely out of time on this one. Great chatting with you. Here is the rural play, viewers, which is really making the waves, both in terms of stock price returns as well as in terms of the way in which the numbers are shaping up. So you want to keep your eye out on this one. What you also want to do is keep the risks in mind, because stock price run-up has been significant. But completely out of time, folks, on this one. Thanks so much for joining us. That's all from both Mahima, myself, as well as everyone who puts the show together. Thanks so much for watching.